Back, everyone. Welcome to our next webinar in the series. This is our third one, and today we're really excited to have Matthew Thomas of National Bank Structured Products Division on the line with us. So for those of you that don't know me, I'm Sheen Patel. I'm the Associate Investment Advisor of the Patel Wealth Management Group. And our business was started in 1981 by my father, Shik Patel, who was a stockbroker back then. As times have changed on, we've actually gone towards wealth management, and that's why we work with so many different partners on our team, and Matt is one of them. So if you do, just before I start and to pass it over to Matt to introduce himself, I would like to just let you know that my number is 905-849-3549, and my email is sheehan.patel@nbc.ca. If you have any questions, feel free to give me a call. And if you'd like to ask questions during the webinar, there's a little thing there where you can do that. So hello, Matthew. Why don't you introduce yourself?
Hello. You guys hear me? You can see me. There I am. There's the red square. Hi, my name's Matthew Thomas. I'm a director with the Structured Products Group at National Bank. I've been in this role for about 8 years, and since I started, the industry has grown significantly, and I'm happy to talk to you guys about that today.
Awesome. Thanks for being here, Matt. So today's a sweet topic that I love. It's called the GIC killer, in my opinion, or also known as the principal protected note. So I'm going to pass it over to Matt here, and he's going to tell us exactly what are principal protected notes.
So principal protected notes are, in a nutshell, exactly what they're called. They're what they do is they essentially protect your principal 100%. So if you hold them to maturity, the worst possible scenario you can ever get is all of your money back. At National Bank, we've actually sort of rejigged the structure. All of our PPNs are now actually GICs. They come with CDIC insurance, but they're also liquid, unlike regular GICs. And yeah, so Sheen, did you want me to get specific about the actual details, or do you want to go Q&A, or?
Well, why don't we, let's just, why don't you tell us a little bit about the history of the principal protected note? I know it was started a long time ago and where we are today. Then we can talk about a little bit about, how you invest in the stock market and essentially take on no risk when you have a principal protected note. And then I'll just keep asking questions back and forth.
Okay? Yeah, sure. So principal protected notes, I mean, they go back as far, I think, either the late 80s or early 90s. There's debate about when they actually started. And when they originally originated, they were kind of designed for people that wanted to have their cake and eat it too, which actually isn't totally possible, but it's a version of it is possible. And basically what they do is they offer equity upside without risk to actually losing your money. And I mean, some people will ask how we do that. I mean, there are you do have to sacrifice something to get that, and that tends to be, you won't get your dividends. But these days, principal protected notes are, I would say, very, very attractive because equities are still low as a result of the situation we're all dealing with right now. So I mean, you're able to get, like say 100% upside linked to, an equity market or a group of stocks with full potential over the term of a product. And if the market doesn't perform well over that time, that the worst you can possibly do is get your money back. The comparative products would be, would be fixed income, and the rates are just so incredibly low that to me, PPNs make a ton of sense right now.
Thanks, Matt. Yeah, totally. Can you touch a little bit on the term of these things? So how long are you locked in? Go from there.
Sure. They vary in term. I mean, over the years, I've seen anything from, sort of even 1.5 to 2 years, all the way up to 10 years. Right now, the sweet spot to get 100%, like 1-to-1 upside on a product linked to an equity market is about 6.5 to 7 years. And that basically means that, if you were to buy, for instance, one of the ones that we are offering right now, it's linked to the Canadian banks, and what you'd get is you get 1-to-1 upside for the banks for that 7 years. So if the banks go up, I'll be modest. Let's say the banks go up 50% over 7 years, which I don't think too many shareholders would be happy with that. But let's say that's what happens. You would actually get, it's a pretty simple calculation. At the end of the 7 years, you would get 50%. That would be your return. It's actually not that complex. What you don't get, as I mentioned, is you do sacrifice your dividends to get the 100% protection on your principal.
Thanks, Matt. I know we've been using PPNs or these flex GICs and all that, and we've been using it because fixed income markets right now basically pay no dividends, no interest, so 0.25%. So why do we like these? So if I was to buy one of these for one of our clients, the reason would be to have fixed income like returns with higher growth on these products. So in the interim, so when you say principal protected, does that mean it's principal protected for the whole term or at the end? How does that work?
No, there's an important distinction to be made there. Could you guys hear me there the whole time? The red light came on a bit.
Yeah.
There's an important distinction to be made there. So your principal is guaranteed at the end of the term. If the market fluctuates, your actual the actual value of the note while you own it, it can go below zero. But they don't tend to be overly, even if the market does go down, they're nowhere near as volatile as an actual equity. But they can go below zero, and they only tend to do so when the market goes below zero. If the market's positive, they generally trade positive as well. But yeah, your actual protection only kicks in at the maturity date, which is actually a nice thing, right? Because the market can go down by, it can go down by whatever, and it can recover in that period, and you'll still make money off of it.
Yeah. So in the times of COVID and 2008, 7 and 8, these things actually ended up becoming positive, and as long as you didn't sell the note at a loss, you would have made money on all these products. So they're great. How do you see most of these PPNs being implemented today in people's portfolios?
It's always tends to be the clients that are trying to replace low yield fixed income, and people that just have had enough of equity markets. There's a lot of people that they kept their equities. I can give you a couple of examples. So I've dealt with a few clients where they actually managed to get a lot of their money back after what happened in late March, and then once they got to a level they were comfortable with and they preserved enough wealth, they're like, all right, I'm gonna get out of these positions. And these are people that are closer to retirement age, but I'm gonna get out of these positions and buy a product where I know I can still get some equity upside, but if markets go south, I know that I'm protected. And then the other group is actually slightly more portfolio management oriented, strategic. Basically, what they're doing is they're saying bonds are just not yielding what we want them to yield. So I don't think they're abandoning bonds completely, but what they're doing is they're taking a sleeve of what would normally just go to fixed income, and they're putting it into flex GICs or PPNs, but whichever you want to call it.
Yeah, that's good to know. Schick and I are both portfolio managers, and that's exactly what we've done with some of our clients' portfolios. The suitability has to be there, and if it is suitable, we will replace some of your fixed income, government bonds, whatever it is, and actually put in a PPN, which could yield some higher returns. Matt, why don't you talk about the different issuers of these types of products? Can I go and buy them from my own bank, or can I go to who issues these things?
They're only issued by Canadian banks in Canada. There's no independent companies really have the capability to issue them. So yeah, they're only issued by the banks. And I mean, from your guys' position, you're not being portfolio managers with National Bank doesn't necessarily mean that you're necessarily going to be married to whatever I'm offering you. You guys have the option, to look at any company, whether it be RBC or CIBC or whoever. And so whoever's providing the best options for your clients, we hope it's us. But you're obviously able to go into the market and find what's best.
So did everyone hear that? Only the banks offer these products. I think that's incredible. You're getting all this protection, you're investing in the stock market, and they're issued by the banks. So say I wanted to sell one of these things, Matt. Who buys it back? Do I sell it to my friend down the street over a stock market, or do I sell it back to you, or how does that work?
They're not. You sell them, but you can sell them anytime you want, but you'd sell them back to the bank. We provide liquidity on a daily basis for all the products we create. It's not liquid in the same sense that a stock would be, but it is liquid daily, and we do provide a market that's that's used daily. It's pretty
Perfect.
simple.
Yeah. Thanks, Matt. I have another question too, because I know a lot of people have been watching TV and commercials and all that, and a lot of push is being said about market-linked GICs. And if you go into your own bank, no matter which one it is, they talk about these market-linked GICs. Is that the same thing as a principal-protected note, or can you elaborate on that a little bit?
Yeah, market-linked GICs. I mean, they're at almost every bank except for ours. We're sort of the first group to create a product that is called a GIC and is liquid. And there's two parts of this that I'll get to. But first, we'll talk about liquidity. So market-linked GICs tend to be illiquid, and you have to hold them for the term. And sometimes some of the terms I don't find to be super attractive. They usually tend to be capped at low levels, especially right now. Whereas the ones that we offer are they are called GICs. We call them flex GICs, but they are liquid. The GICs I think you're referring to, that everyone sees plastered all over the various branches that we see. Those are very much a sort of a retail branch oriented product. And I mean, without, I don't want to step on my own toes here or anyone else's, but I would say that in most cases, investors are way better off coming to you guys to find a product like this, because you can generally get the same level of protection with much better upside.
Yeah, no, thank you. I was going to touch on that. As investment advisors, we actually go to every single issuer on the street and find out who has the best terms. And typically we can do these things in an F-class structure or a fee-based structure. And what that means is the client, my clients, end up getting a much better rate than what you can get at a retail level. So yeah, that's cool. So these things are definitely gaining popularity, eh, Matt? I mean, how big has this market become from where it started?
Oh, I mean, it's getting the exact number, which I actually tried to do in preparation for this conversation. Actually wasn't super easy. So I got it as of 2018. It's over 100 billion. Now a big chunk of that is those retail products I mentioned. But I mean, it's structured products from in the past 7 or 8 years have grown exponentially and are much more popular and have been very, very effective for a lot of people. And then PPNs and flex GICs are very much a part of that.
Okay, yeah. So it started off from basically zero in the 80s, and that's now $100 billion industry.
It's a big industry. Yeah, it's a big industry that a lot of people don't talk about, but yeah. Significant.
It's actually a pretty complicated product. Well, structured products in general are pretty complicated. And today we're talking about principal protected notes, which is actually the least complicated of all the products. How does the bank actually get this, principal protection guarantee for our clients? I think it's really important to kind of touch on how that's created. So yeah.
So I'm going to do my best to explain this and not put anyone to sleep. I've tried to explain this to my wife before, and she thinks it's a bedtime story. But effectively, what we do is with PPNs is we use a zero coupon bond that we with PPNs. They're Flex GICs at National Bank, not PPNs. They used to be. My boss would remind me that if he was here. So we effectively buy a zero coupon bond at the beginning, which matures at the end.
So how does that work before you go any further? What is a zero coupon bond so the viewers know what you're talking about?
It's just a bond that matures at 100 at the end of its term, and it has no coupon.
So we buy it at a discount, is what you're saying at the beginning?
Yeah, we buy it at the beginning. Rates are so low right now that they're, that's why some of the terms are a bit longer than they used to be. Okay. And then with what's left over, we buy options to generate the upside on the product. That's it. It's actually it might be slightly more complicated than that, but not much.
So I mean, and I get this question a lot too. Is there a lot of how does the National Bank or any of the other banks make money on these types of products when we're offering such a great solution to our investors?
We do. No, sorry, go ahead.
No, okay, yeah. So yeah, you know what I mean? Whenever you say the word option, people kind of get scared. So
well, we're a Canadian bank, and we're obviously not doing anything for free. In fact, we're doing all this. Yeah, yes, we're not doing it for free. I was gonna make a joke, but I'll just stay on topic.
Thanks, Matt.
So yeah, we take a relatively small spread. I'm not exact. It differs from product to product and differs based on market conditions at the beginning. So I'm not going to venture to guess what it is. It's well under 100 basis points, I surmise, at the beginning, and that's effectively how we make money on these on these products. What was the second question?
For me?
Yeah, you had something else there, and
Yeah, I just wanted to know how you basically made money on the notes, like the bank made the money on the notes.
Yeah, and for Flex GICs, we're not necessarily as concerned with the spread because these also count as deposits, which banks like deposits. It allows them to do business in other ways, and so yeah, they count as deposits. So there are multiple benefits to offering this type of product that the bank likes.
Perfect. We do have a couple questions, and actually some of these questions that are coming in are actually linking to what I was going to ask next. Can you buy these things inside of registered accounts? And you said we give up the dividend to do so. Does that mean does a PPN provide income at all?
So the first question was,
can you buy it in a registered account?
Yes, you can buy it. Yeah. There's no account limitations at all. So all of the various alphabet you can do. So no problem. Whether it be a RIP, whatever. CFSA, RIP, whatever. There's no limits in that regard. What was the second question? Sorry.
So because you said we give up the dividend, is it possible to get income from something like this?
So theoretically it is, and we have in the past. Most of the time, no. I'd say 90% or even maybe more than that of Flex GICs do not provide income. We can structure them, with a small coupon, but the rate environment we're in right now makes that nearly impossible. So getting a Flex GIC that pays a coupon right now it's possible right now, but it's not likely going to happen.
Thanks, Matt. Yeah, no, actually, I think we actually have a client that bought one of these things a couple years ago, and I think it's a 5-year or 7-year note, and I believe the client gets 2.5% a year. There's only one client of ours that has that.
Yeah, those days, those were the pre-COVID days.
I have another question here too. If you buy a PPN or a Flex GIC, when you want to cash in some of it, can you cash in a portion, or does it have to be the whole thing? Because I think in the GIC world, you have to cash in the whole thing, right? If you wanted to.
I believe. Well, I mean, GICs you can't unless they're cashable. I believe when you cash in a cashable GIC, it's all or nothing. I'm not certain about that though. For us, no, you can if you can cash in half of it, a third of it. There's no limit. You can cash in whatever you want. It's not a. It's just liquid. So I mean, if you like the what the price is of it, then yeah, you can sell it. It's not a problem, and you can sell half of it.
Yeah, I think that, so actually Schick and I do that for some of our clients. They have principal protected notes, and instead of it actually providing income, as long as the notes are positive, we'll sell a portion of it so that it can provide income streams too. Sure. Yeah, so it is possible. For those of you out there, there also are other notes or structured products out there that provide income. We're not going to touch on those products today because this is a very this webinar would probably be like 3 hours long if we did. So we're only going to talk about the PPN today, and then we're going to have a couple more videos where we do it on callable income and also auto callable notes. Yeah, so these things are pretty safe. A lot of our clients use them. We've seen a lot of people actually get rid of their GICs, because GICs right now you're getting 0.5% over a year, if that, because it's just the rates are terrible. So this is another way to get exposure to another market and still have that principal protection. Does anyone Matt? Do you have anything else? Do you have anything you want to ask Matt?
No, everything's clear. What the banks, I notice Bank of Nova Scotia always sells a GIC linked to the Toronto Stock Exchange. I know that because they advertise it in their branch. People have bought them. So are those PPNs like that?
No, they're to the best of my knowledge, no. Those are the ones they sell in the branch at Scotia, best of my knowledge, I don't know for sure, but no, they're not liquid, and you generally have to hold them for the duration.
Correct.
Whereas
yeah, but the principal is guaranteed. You don't lose it even if the underlying index is down at the end of maturity.
No, they're protected. They're GICs. They have CDIC insurance. The main difference would be liquidity.
Okay.
Thanks, Matt. I think that's pretty important for everyone to know. These PPNs are liquid. The stuff that you get at the bank branches at the retail level are not, and they can be anywhere from 3 to 7, 8 years. Don't quote me on the terms. Well, I want to just say thanks, Matt, for taking time out of your day to talk to me over the air, and hopefully everyone enjoyed this little presentation here. If anyone has any questions at all, again, please feel free to email me, sheehan.patel@nbc.ca, or call me at 905-849-3549. If something like this is of interest to you, we can even have Matthew come back on the line, and we can have our own separate meeting, and he can even explain some more stuff. So thank you, Matthew. I appreciate your time today.
Thank you. It would be my pleasure to speak with anyone if they wanted to discuss any of this further.
All right.
Perfect.
Thank you very much, everyone.
Thank you.
We're going to sign off. Take care.
Thanks, guys. Bye.
Bye.